you need to lock in equity at the top of a property market cycle. And I see this a lot when it comes to the changing sands of real estate. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, code cracking stuff. We're going to dig into some of the leading indicators we look at when it comes to property investment. Yes, there is a little cheeky thing out there called a property cycle. And today I want to go over some of the indicators that I tend to look for when examining property markets and the good bits, the bad bits, the trade-offs, to discover what is going on when it comes to market equilibrium. Where are things at? So that's today's show. And of course, welcome back, regulars. Play the program in double speed, get your life back. Of course, all the episodes I've done are actually lessons on real estate. So feel free to dart about, go back in time, explore other episodes I have done. I've done so many now. It's certainly starting to rack up. So I'm sure there's some gold nuggets if you go back and listen. But a lot of people never want to go back. I'm one of those people. I don't go backwards. I only go forwards. So today we're going to dig into supply, demand, yield variation, and of course, we're going to have a look at leverage and capital flows when it comes to real estate investment. So let's do it. Let's tackle the conversation around really the idea of market cycles. Now, quite often when we talk about market cycles, it's typically the conversation around a property clock. At the bottom of the clock, you've got the biggest opportunity. At the top of the clock, as the clock strikes 12, it's really a different point of property investment. And I think it's worth having a chat about what is known as an equity lock, the time that you need to lock in equity at the top of a property market cycle. And I see this a lot when it comes to the changing sands of real estate. Now, it is common, or has been common in recent times, for people to make capital gains out of real estate. Obviously, coming off the back of a pretty significant price escalation through the COVID era. And of course, that has pushed asset values up. Asset prices are more than what they were years ago in just about every marketplace except for Melbourne. So when it comes to protecting your equity, you have to consider that equity is actually just paper. It's very good to turn equity into cash. You need to liquefy your equity. So what happens when markets start to reach their peak of performance? Your real estate that you have invested in often reaches its maximum price point for the short future looking over the horizon. And so by way of example, using easy maths, let's say you bought a $700,000 property during COVID, and today that property's worth $1 million. That's great. Well done to you. Certainly a lot of people I've been working with have achieved results like that. And of course, that $1 million or $300,000 easy math gain is an incredible result. We want to protect that money. How are we going to protect that money? Because once a marketplace reaches its peak, after expansion comes contraction. And it's very common for there to be a price point peak in real estate, followed by price decline. And of course, when it comes to looking at real estate, sometimes we take a snapshot of the here and now. And what can happen is sometimes when we look at real estate, we'll see we've made a $300,000 gain. We'll think, great, I'll do nothing with that $300,000 uplift. But of course, that $300,000 uplift at the peak of a market can start slipping, can start disappearing. It's paper. All of a sudden, $50,000 disappears because we are no longer at the peak of the market. The market is starting to slide. And on a property clock, that slide is really going from sort of 12 o'clock to 1 o'clock. Prices start to fall as the market dynamics begin to change. Now, as a property investor, it's really important to understand property market indicators so that you can start to gauge when a property is reaching its peak level of performance. And of course, it's a little bit trickier if you don't actively look at the market on regular occasions or keep your financial world up to date. Because what you want to be able to do is at the peak of a market cycle, go to a lender and effectively liquefy your equity, turn your equity into money, real cash, that can sit inside of your home loan as an offset. Now, once you turn your wealth into cash, even if the market starts to go down, you don't basically get margin call on that cash sitting in your offset. So back to my example, the $300,000 gain, which is a great gain. We want to grab that money, obviously refinance that out of our real estate using LVR dynamics and turn that into a allowance that we can use. Now, again, like obviously based on LVR dynamics, loan to value ratio dynamics, you won't get access to all $300,000. You might have to juggle that with what you can actually borrow. But the point of what is known as locking in your equity is all about doing it at the best possible time. And it's better to be early than late because you typically can even redo it if you're too early. So in other words, the $300,000 gain, if we liquefy that into cash based on an LVR, it's much better to do that before that gain slows back up and slides to a $250,000 or a $225,000 gain, which is still a great gain, but it's better obviously to take more. Now that will put you in a position where you've got the maximum amount withdrawn from your real estate. And it's a very important principle in property market cycles because cycles change. They change when economic indicators change. And again, if you've been sitting at the bottom of the market and you haven't made any money out of real estate because the market itself has not been moving, then probably that part of the puzzle doesn't apply to you. But certainly a lot of investors have done very, very well. And really the concept is to liquefy your equity into money you can use before there is a slowdown. Now, there may not be a slowdown. There may actually be more capital growth in many marketplaces. The point of today's conversation is merely a lesson on preservation of capital. Remember, investment principles come down to 4 quadrants: preservation of capital? Will you get your money in and out of a real estate deal? Growth, yields, and tax. That's the 4 quadrants of investment. So I've done some work on basically pre-belief property market cycles and belief markets. Obviously, a value market is often basically anyone believing in the marketplace. The bottom of the market is where the sentiment is actually the toughest. And so quite often when we're looking at the bottom of the market, we're actually seeing indicators which showcase why a marketplace is at the bottom of its cycle. So let's go through some indicators which are very common in real estate and really also sit in quite often 4 quadrants. The first one is supply. Supply of established real estate, the existing level of supply, and of course, construction and development. So market absorption and stock on market is a primary principle of real estate. If there's too much stock on the market for buyers is abundant. If there's not enough stock on market, the market for buyers is scarcer. Obviously, the principle of scarcity drives up prices. So you can go to different marketplaces around Australia and you will see a different level of housing supply or existing established supply and buyer demand. Now, by way of example, in Brisbane today, there's a lot more buyer demand and Perth than there is in Hobart or Melbourne. And so the absorption rate of established housing supply and buyer demand is faster. And because it's faster, it clears stock quicker. Because it clears stock quicker, there's less stock to choose for the buyers in the marketplace. And of course, when new stock is brought to market through new housing supply, if there's no established housing supply or a lack of established housing supply, that new housing supply quite often is also in high demand. And so we have to look at the total housing supply dynamics, not just new housing and not just old housing. It all needs to be considered together to work out how things are absorbing. And of course, you can look at population growth versus housing supply. And here in Australia, quite often what we're seeing is high population growth and not enough supply coming through the system. Now, a marketplace like Melbourne is undersupplied versus population growth. So that leading indicator tells us that there is a future undersupply, but it doesn't tell us if there's a current undersupply. To consider the market absorption and stock on market and the current undersupply, you have to actually look at the absorption rate of housing supply of current stock on market and buyer demand. And what you find is there is an undersupply of housing based on population growth, but there is a balanced level of supply based on buyer demand today. In other words, properties are on market and their buyer demand is not there. And so that tells us that the market is a buyer's market. It is more favorable because the buyer can pick and choose between multiple properties at once. And the principle of scarcity, which drives growth, is temporarily not in the marketplace. And so we can also look at things like construction cost and material prices. Now, it costs a lot to build real estate. And because it costs a lot to build real estate, particularly high density and apartments, not enough apartment supply is coming through the funnel in all marketplaces. But that as well is really a bullwhip effect, which you will see not this year, but in a few years' time. If you stop building because construction prices are too high, you're going to feel the impact of that down the track. It doesn't show in today's data if the absorption rate of real estate is not fluid. In other words, if buyers aren't buying the existing housing supply and they're staying put and they're not shifting around and they're not upgrading, downgrading, doing first home buying, if there's less demand for that, then if construction costs are stopping construction, that it is not necessarily going to impact anything today. It's not really a problem for a weak marketplace. However, in a strong marketplace, if you stop production because construction costs are too high and there's wild buyer demand, you can see that that's going to catch up on itself quite quickly. So the first thing from an equilibrium standpoint, and really you've got to consider, is supply. What is the dynamics around market absorption and stock on market? It's really how we find the bottom of the market. The top of the market, we need to really consider other factors to tell us basically where the top is. The top's very, very important because the top effectively allows us to lock in our equity that we've made through the cycle dynamics. And we've got to do that before there is a market correction. So to look at the top of the marketplace, you can look at a few other dynamics. Certainly, I think one of those dynamics is yield compression. So if we were to think of, again, another quadrant, we've got supply, we've got demand, and we'll talk about demand, we've got yields, and we've got investment. They're the four kind of quadrants that we need to shift through to think about indicators. So we'll go to a quadrant around yields, and yields are an important element to understanding if a market is starting to reach the top of its cycle. And what we can do by examining yields is see the expansion and compression of rental returns. Now, when a marketplace is at the bottom of the market, the rental returns can be quite strong, 5%, 6% sometimes. When a market is at the top of its cycle, the rental returns can be 3%. And of course, that means you have seen a compression because rents don't grow as fast as property prices do. So quite often, if you want to look inside of a property marketplace, you can examine the compression of the rental marketplace. And of course, that sort of gives you a bit of an indicator as to where the top of the cycle might be. But if we jump over to demand, market absorption and occupancy, which is really the drivers of housing consumption, there are a few indicators we can look at. We can look at home ownership versus rental demand. We can look at economic conditions and employment. Employment is probably one of the strongest indicators that a real estate market is in or out of shape. Now, in Australia, we're pretty blessed to have a pretty low unemployment rate. It's got a 4 in front of it, which is quite bananas by world standards. It's very, very, very low. If you want a job, you can pretty much have one. And of course, if you don't have a job, if people start to lose jobs, there's obviously momentum shifts in real estate. Employment is probably one of the biggest glues to making sure real estate continues to hold its value. If you've ever seen a town where an industry leaves a high-risk single economy market where a company decides to move out, you see high levels of unemployment and a correlation of price decline. So employment's a bit of an important one. If people have got a job, they buy real estate. If people go to work and the people they've been working with are still at work with them, they buy real estate. If people go to work and notice all of a sudden 3-4 people out of the 10 people in their company are no longer working at their company, they start to begin to slow down their appetite to buy real estate. So economic conditions are an important concept of really where the cycles can find themselves. As are demographic shifts, migration trends, patterns of internalized migration, effectively where people want to live, how old they are, and what type of home they want to live in. These are huge demand drivers, and I've talked a lot about that of recent times, but those housing demand drivers of affordability and lifestyle create preferences on what areas will perform through a market cycle. And of course, some people do argue there really is no major Australian market cycle. It's a bit of a myth. There are market cycles within market cycles. And again, like even inside of Sydney, there are huge amounts of local government areas, different cities within a major city, and they all have different cycles operating at once. They can be interconnected and affected from each other, but equally they can act very differently. I was just down in Manly the other night, and there was a massive, massive crowd huddled around a real estate office, buying real estate in a marketplace where property values are pretty expensive, but the demand from the market was there to be seen. There were literally people lined up around the block to try and buy some real estate that evening at the auction room or in the auction room. Now, if you went to another part of Sydney on the same night, an area where things are not economically happening as much, where there's tougher economic conditions, where employment is a little bit different, where affordability and lifestyle are a bit different, you would see the polar opposite. People are not interested in purchasing the real estate. So remember always, a property cycle can be very niche in itself. Though we talk macro, quite often real estate is really a micro concept. So important to understand. Now, again, obviously when we look at real estate cycles, we're looking at things like, is the vacancy rate strong? Is yield compression happening? What are the market rents in a area? Are the market rents very strong compared to the purchase price? And really, is an area under rented from a rental perspective? But of course, probably the biggest indicators of investment and capital flow and leverage is financing conditions. Is interest rates impacting demand, or are interest rates impacting demand? And of course, right now, for a large proportion of society, interest rates are affecting their ability to buy real estate. That's the reality of it. So it lowers demand and slows down the real estate marketplace. Because interest rates impact investment, quite often people have a budget, so they go shopping, they look at the property which is worth $1 million, and all of a sudden they don't have $1 million, but they can spend $950, and that's how they make their offer. Because no one else can spend $1 million, demand falls to a new price point. And this is the point of the conversation around locking in your equity. If interest rates remain higher for longer, and they may change, they may come down, there's all sorts of variables behind that, but it will affect capital inflow into real estate if affordability is constrained. And that will affect market pricing and, of course, property valuations, investor confidence, and market sentiment. So leverage is probably one of the biggest indicators of how markets are fluid. And conversely, when people have limited budgets and are priced out of a marketplace, they go looking for new marketplaces. And we've seen that already, whereby a property market which hasn't grown over the last 5 years all of a sudden becomes the new place where capital inflow heads. And really that's driven off the idea of market sentiment and affordability. So if we go back to a property clock, quite often at the bottom of the market, there are cheaper properties, tougher property valuations, but because of interest rate and the impact on pricing, more people start to realize they can no longer shop in a faster growing marketplace. They have to redirect their capital to a more affordable marketplace, and that more affordable marketplace becomes the beneficiary of new capital flowing into that economy. And of course, that's when a property market will leave the bottom and start to recover and begin to rise in value. So you see this kind of paradigm shift between where a hot market is, where a peak market is, how markets can slide in value, and of course, how it all goes around one more time. So it is a cycle. It is a cycle. Everything is a cycle. Don't underestimate that. Everything is a cycle. Cycle of life, cycle of health, the cycle of work, the cycle of a relationship, the cycle of real estate. It is all a cycle. And at the bottom of the market, it's probably often the toughest area to buy in because of cycle dynamics. But because of cycle dynamics, buying at the bottom allows you the longest possible growth period because you go through a period of time, a longer period of time. So remember, folks, in a hotter marketplace, you want to start to lock in your gains. In a cooler marketplace, you want to deploy your capital. That's a good way to think about it. And so in the middle, you've got still those rising marketplaces, which sort of halfway between the 2 points. So today I just thought I'd do a bit of a follow-up on property cycles and give you some more insights. But that's it from me. Thanks for tuning in, and I'll catch you on the next episode as we talk more real estate. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.